Hi, my name's Steve from Promise Money, and today I want to talk about semi-commercial properties. If you're looking to raise a mortgage to buy or remortgage semi-commercial property, some of the factors that you might want to consider, importantly, because if you get ticks in all the boxes, it can make a real difference to how much you pay. But let's start off with, what do we mean by semi-commercial? And it's not what do you mean or what do I mean, it's what do lenders mean, and there are various definitions of that. But the key thing is, what percentage of the property is residential use and what percentage of the property is commercial use. And for it to be true semi-commercial, you really need to be more than 50% residential. But that doesn't mean there aren't commercial lenders who will take a view on something less than that. So I think it needs to, if it's more than 80% residential, then lenders are going to say, look, that's residential, really, it doesn't fit into our categories. And then we're talking about a negotiation around something to try and get it onto a buy-to-let product. But if it's 80% residential or less, i.e. more than 20% is commercial, think of it as semi-commercial. But in real terms, the more residential it is, the better rate you're likely to get. And we're not just talking about one property here. We could be talking about a scenario where there are multiple properties owned within a portfolio, some of which are residential, some of which are commercial, some of which are a bit of both. What percentage of the floor space is residential, what percentage is commercial? Try and get it over 50%. That's where you're going to get the better rates, but the higher the better. So that's the first thing. What is semi-commercial? Also, when you think about how much of the income is residential and how much is commercial, and the reason I say that is we've got one lender, well, we've got numerous, but we've got a lender at the moment. They're saying, look, we will lend on semi-commercial properties, and our rates, even though we're a specialist lender, our rates are going to be closer to buy-to-let rates than maybe the commercial rates that you'll get from your commercial lenders who also do semi-commercial. So they're effectively saying, we will lend on this property, but we're going to disregard the commercial income. If it stacks up on affordability on the buy-to-let income, then we will lend, we'll base the affordability on that, and we're going to give you rates which are very close to buy-to-let rates. So if you've got a property where it's got a really strong, I've got one at the moment actually, it's got a really strong residential income, and there's a garage in the back that's let out to a hairdresser's which has got a small income, then if it fits on the residential income, that's going to work well for you, and we can get you into really good semi-commercial rates close to buy-to-let rates. So what's the split of the property? What's the split of the income? Two very important factors. So other factors that we need to just think about in looking at the whole thing is, okay, if we've got a property that's got a residential element, does it have separate access? Because if you've got a commercial property, and let's take the classic, which is a shop, takeaway, whatever it might be, with a flat over the top, if that flat doesn't have separate access, it can't be let separately as a residential property. Therefore, they don't really consider it as residential in most cases. So a lot of the lenders who might say, yes, we'll do semi-commercial, will say, no, actually that's fully commercial because we can't let the property separately. They can't let the flat separately, it's all one. There are other lenders in the commercial sphere who will say, well, actually, we'll give you semi-commercial rates because it is a flat, but you might not get such a good deal because of that. So has it got separate access? That's important. EPCs, that's important too. If you're thinking of getting an EPC, and bear in mind as a landlord, residential EPCs, they're moving in the direction of you need to get it to C or better, probably by 2025 or there or thereabouts. That's the noise, although it hasn't actually been confirmed yet. If you've got an EPC of C and above on the residential elements, that's something we can put forward to a lender and say, look, give us a discount. In some cases, it can get you a 0.25 discount. So that's worth knowing about. Large loan discounts, they're available as well. So one lender loans over £750,000, they'll give you a 0.25% discount. But it's not just whether it's a discount, because different lenders operate in different bands. We've got lenders at the moment that are saying our minimum loan for semi-commercial is 500,000. We've got others saying our minimum loan is £1 million. So if they're big chunky loans, different lenders might come into play, which can give you a better rate. If we're below £500,000, then we've got lenders whose minimum loan is 250, another one is at 150, another one is at 120. So you can see the lower you go down in the loan amount, the less lenders there are playing, therefore there's less choice, therefore the chance of getting the best deal are reduced. And when I say the best deal, it's the if you're not borrowing that much, then you can't expect to get a deal that's significantly better. But the amount you borrow can affect the rate that you get and the lenders that are available to you. Okay, so we've talked about the property, the rent. What is it exactly? Is it in a portfolio or is it a single property? And loan amounts. Let's just look at some other factors now, which is, as a landlord, if you're raising this as a landlord on a semi-commercial property, what is your experience? Because if you are buying a property and you have no experience in this sector before, not even buy-to-let experience, it's going to be tough. A lot of lenders want to see experience, so the number of lenders becomes very, very small, therefore the rates could go up. If you've got good experience in the commercial sector, excellent. Let's demonstrate that to the lender. If you've got buy-to-let experience and you've owned buy-to-lets for a year or two, then that's good. 2 years is ideal, but if it's a year, there are still lenders that we can talk to. But again, the more experience you have, that's better. Another thing that a lender's going to look at, they're going to say, okay, what if, and they always say this, what if it all goes wrong? What if for some reason you can't get tenants in, it's void, it's empty for a long period of time, can you afford it to fill the void periods? So they're going to look at your outside income. If you can prove you've got a good, strong outside income, big tick in the box. If we get a void, we know this guy can afford it or this lady can afford it. If you haven't got a strong income, then some lenders will say, well, we're a little bit nervous about that. They're also going to look at your outside assets. If it all horribly goes wrong and the property devalues because the tenants trash the place, how are we going to get our money back? Are we going to ask for personal guarantees from this borrower? And if we do, what's the value of those personal guarantees? So the worst case scenario for a lender is a first-time landlord who's got no experience, they're a tenant and they've got no assets, they don't own any property. If it all goes horribly wrong, what have they got left to hang their hat on? Or, as a borrower, what skin have you got in the game? And if all you've got is that property, then that reduces your options. Unless, of course, you're going to a lower loan to value, but then you're going to expect to pay more as well, because most lenders want to see you've got skin in the game, you've got assets behind you, you've got some good, strong income, and it's a property they like and the rent stacks up. Okay? Talking about the rent stacking up and not stacking up, again, we're talking about investment properties here, but most lenders are going to expect the rental income to support the loan that you're looking to take out. And when I say support the loan, if the rent is £1,000 a month, the mortgage outgoings are £1,000 a month, that's not enough, because they're going to want a buffer. They're going to want to know that it's more than that. So they'll probably want at least £12,500 a month or per annum, whatever the number is. So if you work on, you need at least a rental income which is 125% of the repayments you'll be paying. But they're still going to look to see what the story is behind that. Have you got additional income for void periods? All of that goes into the underwriting mix. Right, now let's talk about deposits, loan to values and deposits. Typically on semi-commercial, you can probably borrow up to about 80% with a few lenders, and they tend to be the lenders where the property is a lot more residential income, and it stacks up on that basis. So you're probably safer to work on 75% loan to value as being the normal top end for the amount so you can borrow. So you need a 25% deposit. But I would recommend get yourself a 30% deposit, and that's going to open up more lenders for you at the 70% loan to value area. And bear in mind that deposit, you've also got to pay your legal fees, your valuation fees, potential stamp duty. So have that on top of your 30%. If you haven't got it, still ask the question, because there are some decent lenders going up to 75%, provided that you've got some experience behind you and you've got some assets behind you, you're a homeowner or you own another property. So for 75%, that's what you need to look like. Credit history, well, obviously they're going to be looking for a decent credit history. If you've got glitches, a few little blips that have gone away and they've been paid off and settled, well, that's not so bad. There are lenders that will look at that. If you've got outstanding CCJs, you've got a lousy mortgage history, you've been missing payments on that, then it's going to start getting very, very difficult, and we're getting into real specialist lenders, lower loan to value, higher rates. So credit is important. And let's just talk for a moment about a semi-commercial property where you're a trading business. And this could be your takeaway scenario, laundrette. You live in the flat above, you're trading from the place below. So in that sort of scenario, they're not going to be looking at the rent. They're going to be looking at what your accounts show, what your profits are. So make sure that your profits are as high as they can be. If you're taking all the money out of the business and you need it to live on, then that doesn't leave much in there to support the mortgage that you're looking to take out. But in the scenario where you're buying this property, maybe you're currently renting it or renting another one and moving to this property, we can add the rent back into your affordability. So I think having a good, strong set of accounts is important if you're in that owner-occupier scenario. And bear in mind that the lender in the owner-occupier scenario will generally look at your accounts. They'll add back depreciation to profit. They'll add back rent that you're paying now but not paying in the future back into profit. But they will look at your outstanding credit. So if you've got high credit commitments elsewhere, they're going to factor that into your affordability. Because in your accounts, you might not know this, but in the accounts, it often just shows the interest, not as the payments in the accounts towards profit rather than the capital. So they will factor out what are the repayments on those outgoings to make sure there is sufficient affordability for you to afford the proposed loan. So good set of accounts, management accounts if you've got them, bank statements, those are sort of things that somebody like me would want to see at an early stage to say, right, where are we going to go with this? On the subject of bank statements, again, this is more so for your trading companies, but a lot of the better lenders who are offering higher LTVs and lower rates will want to see bank statements as well, whether they're personal because you're buying as an investor and maybe you own the property personally, or if you're buying as a business, the bank statements they're going to look at and say, right, are you paying things on time or have you got bounced direct debits? Are you dipping into an unauthorized overdraft all the time? So anything in your bank statements that shows stress or a reason why you are not keeping up with your repayments on your other credit is going to be a red flag. So make sure your bank statements are sorted out and they're running on rails. That's another important factor. Bounce back loans, that's another thing. If you've taken a bounce back loan in as a trading business, then they're going to factor that in if there's repayments on the bounce back loan. And if you've had a company behind the scenes which has had a bounce back loan and has now gone into liquidation, or you've got anything like that behind the scenes, that's going to come up in your credit searches as well. So not a good sign. So credit important, bank statements important, get everything looking as good as you possibly can. In terms of rates, well, right now we're at a time where base rate's at 5%, and rates on semi-commercial properties can be anything from 2.5% plus base upwards. And we've got lenders quoting rates at the moment. I've got one quoting a fixed rate at 6.58 on a low loan to value portfolio. It's a £3.9 million deal, so it's a big deal, low loan to value. They want it, and they're only charging a 1.25% lender fee. That's probably in the current market as good as you're going to get. At the moment, I would say that rates of round about 6.5 to 7.8 on fixed rates are of the norm for regular semi-commercial properties. That's probably where you want to be. But don't be surprised if you have got credit issues, or you're a first-time landlord, or it's a low loan amount, or you're not a homeowner, or there's a mix of those things. Then you could easily be getting into the 8, 9s and 10% in terms of rates that you'd be looking to pay. I guess the other thing that I should just mention towards the end is some lenders, again the ones that often offer the cheapest rates, will want the loan written on a amortizing basis. So from affordability, they're going to say, what are the repayments? Let's assume the interest will go up. What will the payments be then? Then let's assume we want a buffer of 25% above that, so 125% of your repayments, of your stressed repayments, to cover need to be covered by the rent, and then they'll work it out on a capital and interest basis over up to 25 years, which means that those lenders, because it's on a capital and interest basis and you are paying interest and capital at the same time, the repayments are higher, and that's what they base their affordability on. Other lenders will base it on an interest only repayment, so you're not paying back the interest over the term, the capital over the term, you're just paying interest, therefore your repayments are lower, which means you can borrow more because the affordability calculation comes out better. So we just have to factor that in as well. So if you're looking for interest only, there are less lenders doing it, but there are lenders who do it, and the affordability is going to work better for you because of that. If you're looking for capital and repayment over the term, then the lenders are going to work out the repayments on capital and repayment, and that means you need either a higher profit or a higher rent to support that. Summary: semi-commercial properties. There is no one product. It depends on so many factors. The key thing is to prepare to make sure that we know what the property is, that you've got good accounts or a good rent, decent leases if you're renting it out, your bank statements are good, your credit history is good, and you've got as much experience as possible and decent assets behind you. That's the perfect scenario. Somebody who's ticking all of those boxes. If you don't tick all of those boxes, it's not the end of the world. If you don't tick any of those boxes, it's not the end of the world, provided that you've got a decent deposit, or you're not looking for a loan at 75% loan to value. You're looking for significantly less, and it stacks up on affordability. I think that's about it for semi-commercial. There is just one thing I would add. I did say that most lenders really want the loan to be serviced from the property. There are some lenders which will take outside income, i.e. if you've got a really good job, really strong income separate to the property, you can use some of that. It's called top slicing. You can use some of that to support the rental income and to top it up to a higher loan amount. So if you want to get a loan, you can only afford to borrow this amount based on their affordability calculations, but use some of your own income, you can take it up to here. But I wouldn't rely on that, mainly because if you're going with top slicing lenders, they charge more, they lend to a lower loan to value. It's not such a good deal. So it's best if the rental property or the property that you're buying and running your business from, that your accounts stack up, your rent stacks up, and there's a good buffer difference between what the repayments will be and what the rent is or the accounts show. I've rambled on. That was all very, very quick. I could do it again and slow it down, but I'm not going to. So hopefully you kept up with that. Press the button to go back to the beginning and watch it again. It might make more sense. But importantly, please do subscribe to our videos. Please do like our videos. Please do share our videos so other people get to see them. And go to our website, promisemoney.co.uk, where you can find out more information. Or go onto our YouTube channel, where you might already be if you're watching this, Promise Money YouTube. There's loads of videos on there about commercial, semi-commercial, bridging, residential mortgages, secured loans. There's all sorts of good stuff on there. So if you're a property investor or a business owner, I guarantee you'll find something that will be of use and interest to you. Thanks for watching. Talk to you soon. Bye-bye.